because I haven't the issue with the link at Call
Yeah.
Campus. So what I've been doing, every time I'm supposed to have class, I go on Call Campus and I watch the videos and I do the homework that's in the
Okay.
roadmap. So I have been following, and I'm glad I jumped on today because I do have a few questions, but it's mainly to prepare for the test.
Yes. So just want to start this recording. Okay, so we are busy recording, so they say I must let you know. Okay, so we're going to go through this session tonight, and then next week. Now we have 4 hours, and we have normally if I'm on my own, I only spend about not even an hour because when you talk to yourself, there's not much you can do. But next week we're going to do a revision of everything.
Okay.
So if there's still something, if you have any questions tonight, you're welcome to ask any question. And then as I said, next week, I'm basically going to go through, I'm going to make a slideshow of the more important stuff of all the previous study units
Okay.
or the chapters, and then we can go through everything. So I don't want you to feel that you in trouble. I'm sure that if you've done the homework, you should be there. Okay, I think tonight's session that we're going to work through, I think that's about a 30-mark question is what we're doing tonight. So if you can do this, then you should. Yeah, the rest is theory, but this is a bit of calculation, not calculations, but debits and credits and stuff. Okay.
Okay, perfect.
Okay, so we're going to be looking at the accounting equation double entry system. May I just ask, are you repeating the subject or are you new in the subject?
I'm new, so I'm a part-time student. I work.
Okay.
So yeah, this is the first time I'm doing this module.
Okay, no, that's fine. No, some of the full-time students are repeating, so then there's some stuff that they know that I don't want to, continuously repeat. But okay, if you're new, it's wonderful. I'll take you through everything. Okay, so the learning outcomes that we'll be looking at, we're going to analyze transactions on the accounting equation. We can look at the definition of assets, non-current assets, and current assets, which we have done before, but okay, we'll look at that. And liabilities, that is non-current and current liabilities. Explain what a proprietary account is, define income and expenses, and then discuss the motive, the gross profit, net profit arrived, and explain and apply the rules of double entry. And then we're going to do some transactions, the typical. There are not many different transactions that happens in a company's books. They sell something, either cash or on credit, and then there's very simple. There's one entry for cash sales and one for credit sales. They buy on credit or they buy for cash. So there's one entry each, and then they pay expenses, and then So it's not a lot of different entries. Accounting is actually fairly simple if you just look at the different types of entries that we will be doing. Okay. Let's just go in. Okay, so this is now the whole principle of a double entry accounting. Now, the point of double entry accounting is for every debit, there must be a credit. And vice versa, for every credit, there must be a debit. Okay, do you understand T accounts? Have you heard of T accounts?
Yes, I have. I think
Okay.
this was posted on Call Campus. I think I went through this. This is where I was having a bit of not challenges, but I noticed that I probably need to listen to you explain it,
Okay.
so that I can keep practicing.
Okay. This is now. I'm just going to. It's been on before this slide, and we're going to just go through it again. So the T accounts, if I could just, and you must excuse me, difficult. I'm not good at drawing with the mouse, but let's try. What is that? There we go. Okay, so a T account looks like this, and like this. And then we've got a debit on this side. I'm not going to Debit says DR for debit. And a credit on this side. Now, for me to explain to people the way that when I do books and I do books for a living, apart from teaching, I have companies that books I'm doing. But we look at if this is your bank account, because one of the main asset accounts is your bank account. That's where your money is sitting. Okay, so when money comes into your bank from the left-hand side, so we debit our bank account, and if it goes out, we credit our bank account. Okay, so if you think about it, if money comes in, then my value of my money in my bank goes up. So that's why we say if it's a debit, it increases. If it's a credit, it decreases. So that is from my bank. I'm just going to put a B for bank there, then you know what I'm referring to. Okay, so money comes in on the left-hand side, so we debit our bank. That means our assets increase, and we get credit the bank, it decreases. Okay, so if we then look at income, so if we do the income, let's take a sales account. Now, obviously, if money comes into my bank on the left, then I must do my sales on the right-hand side, on the credit side. Okay, because for every debit, there must be a credit. So if I have a sale, I'm going to record my sale there, 100 Rand. Okay, and I'm going to, so I credit my income and I'm going to debit my bank. There it goes, my 100 Rand. So on the income side, when that increases, when we credit it, it increases. So my sales increase on the credit side and it decreases on the debit side. That clear?
Yes.
Okay, so capital, that's the owner puts money into the business. Okay, again, he puts the money in the, if he puts money in the business, it's going into my bank. So there's the money going into my bank. On the debit side, it means I've got to credit this account, the capital account. And so I credit that and it goes in on the debit side of my bank. So again, capital, if I credit it, it increases. And if I debit it, it decreases.
Okay, debit.
Okay. Liabilities, that's the stuff I must still pay. So if I bought some stock on credit, I have to pay that. Okay, so let's say that's my creditors or accounts payable. If I pay, it's got to go on the credit side of my bank, and that means I've got to debit my liability. Okay? So that means when I debit my liability, it reduces the liability. So when I buy stock, I'm going to credit my liability. If I buy on credit, I'm going to credit that account and I'll debit. I don't have the account here, but on my asset side, I will have an inventory or stock account and I'm going to debit that. So with liabilities, if I increase it, it's a credit, and if I decrease it, it's a debit. Okay? Expenses like salaries, wages, rent. Again, I'm going to pay it out of my bank. I'm going to credit my bank, the wages, and then it means I'm going to debit my expense account. So if I debit expenses, that increases. And if I credit it, it decreases. Drawings, drawings is any money or goods or assets that the owner takes out of the company. So if it's cash, it goes out of my bank. So I'm going to credit my bank and I'm going to debit my drawings. So if I debit drawings, it increases. If I credit drawings, it decreases. So that's the basic principle. Okay, is that clear?
Yes, it is.
Okay, 100%. So if you understand those basic principles, then no problem. Okay, so again, the definitions that we have. When we say we debit, it means on the left-hand side of the T account. And if we credit, it's on the right-hand side of the T account. Then we have the formal definitions. The asset, what is an asset? It's a resource controlled by the company or entity from a past event, which will increase future economic benefits. So take we bought a truck, which we're going to use for deliveries. Okay, so the resource is the truck. The past event is we purchased it, and we're going to use it to make deliveries, and we're going to charge our customers. So that means we're going to get money. So that increases economic benefits. So that's the formal definition of an asset. Liability, that's an obligation to pay something, to settle something. Again, also from a past event, which will reduce economic benefits. So if we purchase that truck and we got a loan from the bank, the liability will be the loan. Where did it come from? The past event when we purchased the truck, we got the loan, and we're going to repay it every month. And as we repay it, the money goes out of our bank, so that reduces our economic benefit. Income, that's money coming into the business, so that increases our economic benefit. Expenses decreases the economic benefit. As we pay the money out, the benefit decreases. Owner capital, the owner, or that's a proprietary capital, and a proprietary account is the same thing. Okay, so capital is the owner that gives something to the business. It can be cash, can be assets. It doesn't have to just be cash. So if the owner has a truck that he wants to give to the business and put in the business's name, you can do that, and that comes in as capital into the business. Drawings, that's what the owner takes out of the business, and it can be cash, it can be assets, it can be stock, anything like that. Okay, so that is your drawings. It's just a repetition. We've discussed this before, but as we repeat, hopefully it gets stuck in someone's mind. Okay, the accounting equation. We say that assets is equal to owner's equity plus liabilities. I think we've done this before, but we're going to do some more calculations on this. So assets, and this equation must always balance. Whatever you do in your books, must always balance. So if you increase your assets, it means on the other side, either owner's equity or liabilities must increase. If you decrease your assets, either owner's equity or liabilities must decrease. Yeah. So if we do the simple maths or algebra, if we now want to calculate what owner's equity is, take owner's equity to the left. Owner's equity is equal to assets minus liabilities, and liabilities equals to assets minus owner's equity. Okay, so but this is simple, basic algebra maths that we should know. Okay, so let's have a look at this example. A company's total.
Let me just grab my calculator.
No problem.
Okay.
Okay. So a company has total assets of 263,000 and total liabilities of 125,000. Calculate the value of owner's equity. So we say assets is equal to owner's equity plus liabilities. So if we do take the owner's equity to the left, we say it's equal to assets minus liabilities. So there's my asset, 263, less my liabilities of 125,000. And that will give me owner's equity of 138,000. 263 minus 125. Okay. Is that okay? That clear?
Yes.
Okay, so let's have a look at the next one. A company has total assets of 572,000, owner's equity of 375,000, and current liabilities of 26,500. Calculate the total value of non-current liabilities. Okay, owner's assets is equal to owner's equity plus liabilities. Now we want to know what the value is of our non-current liabilities. So we're going to say liabilities. Sorry, liabilities equal to assets minus owner's equity. So there's our 572. The assets minus our equity of 375. So liabilities in total is then 572 minus 375 is 197. So the total liabilities is made up of non-current liabilities plus current liabilities.
Oh, then I add them.
So you will say, okay, my non-current liabilities or my current liabilities is 26,500 and total liabilities is 197. So you're going to take the 197, subtract the 26,500. That is my current liabilities, and what is then left is my non-current liabilities. Okay, you follow that?
Yes.
Good. Let's have a look at another example. The company has owner's equity of 295,000, total liabilities of 78,900, and non-current assets of 33,800. Calculate the value of current assets. So again, assets is equal to owner's equity plus liabilities. So there's my owner's equity, 295. My liabilities is 78,900, which means my assets is equal to 373,900. Okay. We say the non-current assets is 33,800. So if we remove the 33,800, here's my 373,900 minus my 33,800. And that leaves me with current assets of 340,100.
Yeah.
Okay.
Yeah.
Okay, so the accounting equation, transaction analysis. If we look, and I'll talk you through the various transactions. We normally look at what is the transaction, what accounts are affected, what elements are affected, and which accounts do we debit and which account do we credit. Okay, so it's just before we get into the various types of transactions, we have to look at inventory or stock. Now, the way that we account for stock or inventory, we have two different methods. The one is called the perpetual inventory system. On the top there, perpetual inventory system, and we have the periodic inventory system. Okay? There's a perpetual, there's a periodic. What is the difference between these two? Perpetual inventory, when you buy stock and you know the price of every single item that you've purchased, you will get that stock, buy it, and you apply a markup to the actual item. And then we account for it in a certain way. The periodic system is where you don't know the actual price of every single item that you've purchased. For example, if you go to a Food Lovers Market, you're going to buy some tomatoes. So they have the loose tomatoes on a shelf, and you're going to pick 5 of them, and they're going to put it in a plastic bag, and they're going to weigh it and charge you a price for it. Now, when they purchase those tomatoes, They went to the market. They go to the market virtually every day, and they buy hundreds of boxes of tomatoes, and they empty them on the shelf. But the price of tomatoes changes every day. So when you buy one tomato, you pick one tomato off the shelf, there is no way that they would know what the price of that particular tomato was, okay, because every day the prices of the boxes changes. So in that case, we use what is called the periodic inventory system. Okay. So the periodic inventory system, and I'll explain what the difference is in the way that we account for them. When inventory is purchased, when you buy stock under the perpetual inventory system, we take the stock and we put it into our inventory account, which is an asset account, and we're going to debit that account. So you buy 1,000 Rand worth of stock, it goes straight to our inventory account. When we buy stock on the periodic inventory system, we simply expense it to our expenses, and we call it purchases, and the whole amount goes to the purchases account, which is an expense account. The inventory account is an asset account. Purchase is an expense account. So when we sell the stock for the perpetual inventory, there are two legs to the transaction. The first one is we record the sale. Okay, so if I sell 100 Rands worth of tomatoes, I'm going to credit my sales 100 Rand, and I'm going to debit my bank 100 Rand. So that is how we will record the sale. But whenever you have a sale, surely the item that you sold costs something, and you have to bring that cost into the equation. So that is when we now move the stock from our inventory account to our expense account. So let's say you sold 100 Rands of tomatoes, but it cost you 60 Rand. So you will then remove 60 Rand of tomatoes from your inventory, and you will put it as an expense. So you will credit your inventory account, thereby reducing it. Remember, inventory is an asset account. If we credit it, it reduces. And then we're going to debit our expense account. And now it's suddenly your assets is less and your expenses shows, and your expenses reduces your owner's equity. Okay, when we do it under the periodic inventory system, we simply sell it. You just record the sale, 100 Rand sales, 100 Rand into your bank. That's the difference on how we do that. So if you ever get a question, they should tell you which system you are using, whether it's a perpetual or the periodic inventory system.
Okay.
Okay, so the third point is additional costs incurred to get the inventory into the shelves. What happens to that? When you import stuff, you pay import tariffs. When you have stock delivered to your warehouse or to your shop, you pay transportation or carriage, as they call it, carriage costs. Now, all of that gets added to the value of your inventory. So those costs will be added to your inventory account. Under the perpetual system, under the periodic system, they will simply be expensed. You will just say, okay, I paid import tariffs of 2,000 Rand, and you simply put it as an expense. So that's a slight difference there. Because the trading inventory account, under the perpetual inventory system, as you do a transaction, you update the inventory account. Under the periodic inventory, we don't deal with an inventory account, so we simply show the purchases and the sales. There's no inventory account involved there. Your cost of sales, that is, as I said earlier, you bought it for 100 Rand, sold it for 100 Rand, but it costs 60 Rand. So that 60 Rand is your cost of sales, which if you look there, there's your cost of sales. this is what we're referring to. So the cost of sales is recorded at the point of sales. So when you do a sale, you record the sale, 100 Rand sales into the bank, 100 Rand, 60 Rand out of my inventory account and 60 Rand to cost of sales. Okay. Under the periodic inventory system, there's no cost of sales. Okay. It's a bit technical, but you'll see when we start doing transactions, how it works.
Okay.
Okay, let's have a look. I want you to just draw, if you have a piece of paper, just draw a little table that looks like this with the date, assets, owners, equity, liabilities, account debit and account credits. And then some lines. Just if you could just draw that quickly, then we will work through the transactions.
Okay.
Okay. So let's look at the first transaction, and I'm going to try and talk you through the transaction so that you understand exactly how it works. I normally analyze transactions from the point of view of my bank account because I love money, so I know when money comes into my bank and when it goes out of my bank. And then I can work from there exactly what a transaction is. So if we look at Mr. Cray's recently opened a small marketing consulting business called Markets, which started trading 1 May 2014, and then the following transactions took place. On the 1st of May, Mr. Cray's transferred 150,000 from his personal savings account into the account of the business's name. So if we have to analyze the transaction, we received 150,000 into the bank account of the business. Okay. And where did it come from? It came from the owner.
From the owner. So isn't that capital?
That's capital. So if we look at our equation, first of all, it comes into our bank. So our assets will increase by 150,000. So we will say plus 150,000 under the asset column. Then if we go to our owner's equity.
It will minus.
No, it is. Remember, it must balance. This thing must always be equal to.
Okay.
Try and make an equal sign. So the 150, if it's plus 150 this side, it must be plus 150 on the other side. Okay. Then we have to say, okay, which account is debited and which account is credited. Okay, we said the money comes into our bank. So then we know we debit money coming into our bank. So we're going to debit our bank. And where did it come from? From owner's equity. So the capital account, as you correctly said. But then if we debit our bank, it means we have to credit the capital account. Okay. Happy?
Happy.
Okay, let's have a look at the next one. The company purchased a laptop computer from PC Planet to assist with presentation and consulting tasks. The laptop was priced at 15,000 and was purchased on credit. So let's analyze the transaction. We got a computer equipment of 15,000. Okay. And we haven't paid for it, so we still owe the money on that. So we're going to have a liability. So which accounts, where will you put the 15,000?
My 15,000 is a liability. So I'm going to increase my liability.
Yes.
And then I'm going to, which other one?
The equipment, you remember you purchased the equipment, the computer for 15,000. Each of these transactions must have two legs.
Okay.
So the assets increase by 15,000.
Because it's equipment for the company.
That's right, yeah. So your assets increased and your liability increases by 15,000 because you owe the creditor that money.
Okay.
So
Oh,
there
let
you'll
me
see.
see. Okay, okay.
So the assets increased by 15,000.
And then liability
No, but it's
increase.
increased by 15,000. Okay,
And then
so
owner's equity, I put a 0. Oh, okay.
it's 0, yeah, it's not involved. So computer equipment is an asset, so we're going to debit equipment, computers, and we're going to credit the creditors account. Okay.
Okay. Creditors. All right, it's coming slowly. I'm getting there.
That's fine. Okay. Let's look at the next one. Mr. Cruz decided to take a loan from Easy Bank to help fund his business. 80,000 was deposited into the company's bank account and is repayable in 5 years' time. The loan incurs interest at a rate of 15% per annum. Okay, so what is the transaction here? Can you try and analyze it for me?
Yeah, Mr. Wilson. So he took a loan of 80,000.
Yes. So where did the 80,000 go to?
It went into the bank, the business bank account.
Okay. So that means our bank increases by 80,000. So our
And then
assets
bank
will
is an
increase.
asset. Okay.
Yes.
All right. Bank is an asset. Okay.
Okay.
I'm gonna say plus by the asset 80,000.
Yes.
And then because it's a loan, it's a liability, correct?
Yes.
So I'm gonna put plus 80,000 under liability as well.
Correct. 100%. And so we will then say it is, we're going to debit the bank by 80,000.
It's bank, yeah.
And we're going to credit the loans account called loans as the liability account.
Okay, so this exercise is basically almost like a combination of the buildup of all the other things.
Yes.
It's okay, so I need to go back to really know those other ones so I'll be able to do this part perfectly.
Yes. Because
Okay.
this is how we do our books. Remember when we talked about the accounting cycle, we said you do journal entries. Now this is basically, if you take this line here, you will say, okay, you're gonna the journal entry will say debit bank by 150,000 and credit capital by 150,000. And that is the actual journal entry that the bookkeeper will enter into the books.
Okay. All right.
Okay, so let's have a look. The interest, we don't worry because we're not paying anything yet. Okay. If, it's only when it's due and payable. Okay, unfortunately the way they explain it in this textbook is not 100% clear. And something becomes an expense when it is due. Okay. So when you buy something on credit, when you receive that invoice, then you will actually do the entry. Say that the entry happened there because that's when the expense was incurred, not when you paid it. Okay. So unfortunately, over here, some of the transactions we work cash, which is no problem because some expenses you pay, and then that happens then. The same with income. Income is not when the money comes into your bank. If you have a sale, that is income. It will sit against a debtor's account, and when the money comes into the bank, you'll just clear the debtor's account. But the transactions happen when income is earned, not received, when it's earned, and when expenses are incurred, not when they're paid. And that's just something in the background. Just keep that in mind. So that's why I say this interest of 15%. It's not due yet, so you're not going to do any recording. You're going to ignore that. Okay, on the 12th, Mr. Cruz paid wages of 500 Rand to a casual worker who helped hand out advertising pamphlets. Okay, so analyze that transaction for me.
12th May, Mr. Cruz pays wages of 500 to a casual worker. Isn't wages a liability?
Okay. He is paying the wages, so it is an expense. A liability is something that you still need to pay, that you owe to someone. But when you pay wages, it becomes an expense.
Expense.
Okay.
out advertising pamphlets, mark service others. So I would think I would put 500, I'd say plus on the liabilities column,
No, it's not a liability, it's an expense.
an expense.
Which expenses and income goes under owner's equity.
Oh, okay. So
Okay.
I would put it under owner's equity plus 500.
Okay, when you owner's equity is the money that the capital that the owner owns. So if you pay money out, if you have an expense, it reduces the owner's equity.
Okay.
If you have a sale income, it increases the owner's equity. So, but just think about it. If you say that 500 Rand, where did it come from? It came from my bank. So I'll reduce my bank.
I'm removing it, I'm minusing it, okay.
Yeah. So if you minus the bank, I'll show you now, there I'm minusing my assets. So if I minus it on this side, it means I have to minus it on the other side. Because I'm reducing, because if this is minus 500, I can't have a plus 500 this side, because this must still always balance. That clear?
Yeah.
Okay. So under owner's equity, under owner's equity, you have capital, you have drawings, you have income, and you have expenditure. They all fall under owner's equity. Okay, so we've done that. Okay, on the 15th, Mr. Kreis provided consulting services to a client, for which he provided the client with an invoice of 1,800 Rand. The client agreed to pay Mr. Kreis the amount owing in June. Okay, we're now in May. So the transaction is he provided service. So there was a sale, but in a service organization, we call about either fee income or services provided. Okay, but it's income that he has earned, 1,800 Rand. Has he received the money yet? No, he has not.
No.
So it goes to also an asset and accounts receivable. Okay, someone owes the business money. So we're going to increase, if we increase our owner's equity sales, I increase that side, and now I have to increase my assets. Okay, accounts receivable, debtors, these are people that owe money to the business. So those are assets. Okay, so I will increase my assets by 1,800 and increase owner's equity by 1,800. So the account debited is accounts receivable or debtors. And the account credit is service income or fee income or income. Not that critical, yeah, but it is income. Okay. Remember, if the person had paid the money, we would have had the sale plus 1,800, and we would have shown 1,800 in our bank. So it's not in our bank, but it's in the kitty to come into our bank. So that is the same. So debtors, that's basically the kitty where the money is sitting, waiting to come to my bank. So it was an asset. Okay. Mr. Kreis developed a marketing plan for a client who paid 6,000 in cash for the services received. Okay,
so he's receiving income.
He's receiving income, yes.
That's good for the bank. It increases the bank.
It increases the bank. So you're going to have your assets increase by 6,000. But where did the money come from? It came from services rendered, so from sales.
Sales.
So that under your owner's equity.
Owner's equity, okay.
So it will sit there. So the account we're going to debit is called our bank. And account credit is called our service income.
Service income.
Yep. Okay.
Yeah.
And then on the 19th, Mr. Kreis used the business debit card to buy his daughter a birthday gift of 450 Rand. as he left his bank card in the office.
So this is it's owner's equity minus 450
Correct.
because he's removing the money. It's going down.
Yes. And what is the other side? Where is it going out of?
The bank. So minus asset.
Yes. Minus assets 450 and minus owner's equity 450.
450. And
So
then
we
the account.
we know
Account being debited, will I say bank?
the money is going out of the bank, so the bank gets credited.
Oh, the bank gets credited.
And then drawings is debited.
Drawings.
Drawings, we debit our drawings account and credit our bank account. Then on the 28th, we paid 5,000 Rand to PC Planet, part payment of the amount owing. So let's have a look. There's PC Planet. It's on the. We purchased that computer of 15,000 from PC Planet. So let's look at that original transaction. PC Planet 15,000.
Yes,
We debited our computer equipment and we credited creditors.
Yes.
Now we're paying our creditor with 5,000 Rand. So 5,000 Rand goes out of my bank.
Oh, minus asset, 5,000.
Minus asset, but it means then that I'm also going to minus, because it must be balancing. I'm going to reduce. If I owe someone 15,000 and I pay 5,000, it means I reduce my liability. My liability will also come down by 5,000.
I have a question. So I'm picking up a pattern. With all these transactions, there's always an amount in my bank in asset. Will this always be the case or not? I must always just concentrate on what is being asked.
It's not always in the bank, but most of the times there will be a transaction assets and then a transaction on the other side of the equation.
Okay, okay, because that's what I'm picking up. Okay.
But for example, you can have two transactions on the asset side. For example, if you buy inventory for 1,000 Rand cash, okay? So you're going to buy inventory, which is an asset. So your inventory will go up by 1,000. And then you paid cash 1,000. So your assets will come down by 1,000. So in the same month, you're going to have, for example, a plus 1,000 and a minus 1,000.
Okay.
Next week, we'll do some more transactions and you can see how that will work. I'll give you some examples of that.
Okay.
But yes, it is 9 times out of 10, there is it affects your bank account.
Okay.
Okay, then on the 31st of May, we paid the full month's interest due on the loan. Okay, now you have to calculate what the interest is on my loan.
So I go back to that original.
We go back to that loan of 80,000. And we calculate 15% interest on 80,000. You've got your calculator?
Yes, I do. Is it 12,000? I get 12,000.
Okay, but 12,000 is for a full year. And this is only for 1 month. So you're going to divide the 12,000 by 12 months.
So it becomes 1,000.
1,000 Rands, your interest, yes. Okay, so how are you going to do that transaction?
This is interest. Am I not going to increase, what do you call this? I'm going to increase my bank. No, I'm decreasing.
You're decreasing your bank. Okay? And interest is an expense.
Oh, so interest is an expense.
Yeah. So there's our 1,000 Rand. We reduce our bank by 1,000 Rand. And we will reduce our owner's equity by 1,000 Rand. So if I decrease my assets, I credit it. So I credit my bank. And owner's equity. If I credit my bank, it means I've got to debit the expense account, the interest on loan or interest expense. That clear?
Yes.
Okay. And that's basically what I wanted to work through this evening. What I suggest you do, the other people, yeah, we're going to do revision next week. I'll send the probably post it tomorrow sometime, the roadmap. But we're going to do a revision. So if there's anything in particular you want me to cover in the revision, okay, please send me an email. And
Okay.
because at least we're having a bit of a one-on-one, so it's easier, and then I can help you with your specific problems. So if you have anything you want me to address, we can do that next week.
Okay, no, thank you for today's lesson. It helped because now I know where I need to focus on.
Yeah,
And then so it's almost like I need to first go back to understanding those other parts, know exactly what's an asset, and then this part will become a bit easier.
that's right. Yes, absolutely. Okay. Well, thank you for attending. Sorry that we missed each other the first couple of times, but we
We
still
are
have the
here.
rest of the year. So
That's true. No, thank you very much. I will
thank you.
definitely keep practicing, and then next week I'll come with where I have challenges.
Okay. Thank you. Have a good evening.
All right, bye.
Bye.